Hello and welcome to your ultimate guide for the California property and casualty insurance examination. My goal today is simple: give you everything you need to fully understand the key concepts, master them, and walk into your exam with total confidence. In this video we'll cover rating organisations, rating agencies, risk identification, financial ratios, premium cancellations. With over 100 plus success stories, we have proven our videos will help you pass your exam on the first attempt. And remember, our website offers free exam guides and practice questions to help you ace your exam. You will find the link in the description below, so be sure to check it out and get the resources you need to study smarter, not harder. So let's get started.
Let us begin with the organizations that quietly run insurance. Insurers do not work alone. A web of advisory and rating organizations collects data, builds rating tools, and writes standard forms that companies rely on daily. The exam wants you to know what each one actually does, not just its name, so let us map them out. A rating organization is a group whose main purpose is collecting loss and expense statistics, developing pure premium rates, and presenting those rates to the insurance commissioner for approval. California law formally recognizes this role, especially in workers' compensation. Keep that definition handy because the exam often hides it inside a question about who develops insurer rates. First, meet the Insurance Services Office, called ISO. This is one of the most important data organizations in property and casualty insurance. ISO collects loss statistics from many insurers and supplies pure loss cost data. That means raw claims data only, with no company operating expenses and no profit margin built into its numbers. So why does that matter? Because each insurer takes the ISO loss cost and adds its own expense and profit loading to reach a final rate. Picture two companies using the same ISO data yet charging different prices because each adds different costs. ISO also drafts standard policy forms and helps insurers meet state filing requirements. Next is ACORD, the Association for Cooperative Operations Research and Development. This non-profit standards group is best known for the familiar application forms producers complete every day. ACORD creates those standardized forms and builds data exchange standards, letting agents, insurers, and others share information smoothly. It makes industry paperwork and data speak one language. Now, a California favorite, the Workers' Compensation Insurance Rating Bureau, known as the WCIRB. This is a designated rating organization for workers' compensation insurance here in California. State law spells out its specific purposes, and the exam loves asking which organization fills this exact role in California. Remember that name firmly because it is a frequent question. What does the WCIRB actually do? It provides reliable workers' compensation statistics, collects data to develop pure premium rates for the commissioner to approve, and writes the classification rules that sort employers into groups. It also inspects risks, audits employer payrolls within 1 year after a policy expires, and exchanges experience data with other rating organizations. You should also recognize the National Council on Compensation Insurance, called NCCI. Not every state runs its own bureau. California uses the WCIRB, while many other states rely on NCCI. NCCI provides loss costs, experience rating plans, and classification codes used widely outside California. Picture the WCIRB as our specialist and NCCI as the national counterpart. Here is your exam tip. Expect a question on what data ISO provides, and the answer is pure loss cost data, never a finished rate. To remember the four players, try this. ISO gives information, ACORD gives forms, the WCIRB rates, California Workers' Compensation, and NCCI handles it nationally. One name, one job, easy points. What we just covered is exactly the type of material in our free practice question bank. These are not basic recall questions either. They are written to test the deeper understanding the real California exam expects. So working through them now reveals any soft spots while you still have time to fix them. Now let us shift to the independent financial rating agencies. These organizations answer one fundamental question for consumers, producers, and regulators. Is this insurance company financially strong enough to pay its claims? A financial rating is simply an expert opinion on an insurer's financial strength and claims paying ability issued by an outside agency. The agency most closely tied to insurance is AM Best. It publishes financial strength ratings focused on an insurer's ability to pay policyholder obligations, looking at balance sheet strength, operating performance, and business profile. California law itself even references an A- rating or better from AM Best as a threshold, which shows how respected these ratings are. 3 more global agencies round out the group, and you should know them by name. Fitch Ratings evaluates an insurer's financial strength and ability to meet policy obligations. Moody's Investors Service assigns financial strength ratings that help large investors judge stability. Each one independently studies a company and forms its own opinion about how solid that insurer really is. The 4th major agency is Standard & Poor's, often shortened to S&P. Its financial strength ratings for insurers are widely referenced. Across all 4 agencies, a high rating signals strong reserves, solid capital, and a reliable track record. A low rating warns the insurer may struggle to pay claims, especially during a large catastrophic event. Here is the part most students miss, so focus closely. All 4 agencies are independent. They are not government bodies, not the insurance department, and not regulators. They do not set your rates or write policy forms. Their ratings speak only to financial strength and claims paying ability. Confusing a rating agency with a regulator is a classic trap. To lock this in, try a simple hook. Picture 4 judges scoring one insurer on financial health, and their names give a quick list: Best, Fitch, Moody's, and Standard & Poor's. Remember, AM Best is the one most devoted to insurance. Independent financial strength, claims paying ability, those 3 phrases answer most rating questions. I know we are covering a lot, and you might wonder how to practice applying it all. That is exactly why I built those free practice questions. They let you work through problems that combine several concepts at once, which is precisely how the real exam tests whether you truly understand the material. Let us move into risk management and how professionals identify loss exposures. A loss exposure is any condition or situation that creates the possibility of a financial loss. Before a policy can be priced well, those exposures must be found. Risk management is the organized process of identifying, evaluating, and controlling them using several methods. The first method is the risk analysis questionnaire or checklist. These standardized forms prompt an organization to consider many possible exposures. The advantage is they are systematic and easy to use, so common risks are rarely overlooked. The disadvantage is they can be too generic, missing unusual exposures, and may grow outdated as new risks emerge. The second method is financial statement analysis. Here you review the balance sheet, income statement, and other records to spot exposures tied to assets, liabilities, and income. The advantage is it uses documents the company already has and can reveal indirect exposures like business interruption. The drawback is statements look backward and may miss contingent liabilities. The third method uses flowcharts and organizational charts. These visual diagrams map operations, supply chains, and structure so you can see where a loss might interrupt the business. Their real strength is revealing interdependencies, because one loss in the chain can ripple outward and affect many others. The downside is they take real time to build. The fourth method is the on-site inspection, sometimes called a physical survey. A trained inspector directly observes the premises, operations, and equipment. This reveals hazards documents cannot show, like worn equipment or unsafe conditions. The limitation is that an inspection captures only what is visible that day, and it can be costly for companies with many locations. Two more methods round out the toolkit. Contract and document analysis reviews leases, permits, and agreements to find liabilities a company has quietly assumed by signing, though it needs legal skill to interpret. Interviews with managers and frontline employees surface knowledge that never appears in documents, though quality depends on how informed and honest each person is. Here is the key exam insight. No single method is complete on its own, and the exam loves testing that idea. Inspections reveal what can be seen, financial statements reveal what was recorded, checklists reveal what was anticipated, and interviews surface what experienced workers know. Expect questions matching a method to one of its advantages or disadvantages. To remember the methods, picture a detective gathering clues from every direction. She reads the paperwork, walks the scene, fills out her checklist, and questions the witnesses, because relying on only one source would leave dangerous gaps. That single image keeps the methods connected and reminds you why a thorough risk manager always blends approaches. Now a distinction the exam loves: direct losses versus indirect losses. A direct property loss is the immediate, tangible, physical damage caused by a covered peril. When a fire destroys a warehouse, the burned building and ruined contents are the direct loss. The peril is the cause, and the destruction is the immediate, measurable result. An indirect loss, also called a consequential loss, is a financial loss that flows as a consequence of the direct damage rather than from the peril itself. It is the ripple effect, not the first impact. These losses come from the disruption the direct damage creates, and they can quietly grow far larger than the physical damage that started them. Let me make this concrete with the classic example. A restaurant kitchen is destroyed by fire. The charred ovens and walls are the direct loss. But while repairs drag on for months, the restaurant earns no revenue, and that lost income is the indirect loss. Another is extra expense, the added cost of running from a temporary location. There are more indirect losses worth knowing. A landlord whose building becomes uninhabitable loses rental income. A clear indirect loss. With contingent business interruption, a manufacturer halts because a key supplier suffered damage, even though its own property is untouched, and loss of use means losing the value of using property during repairs. All flow from a direct loss. So why does this distinction matter so much? Because indirect losses can be larger and more devastating than the direct damage itself. A business can rebuild a $500,000 building, but 2 years of lost revenue may end it forever. Remember, standard property policies usually cover only direct losses unless indirect coverage is specifically added. Here is a memory trick that sticks. Think of a stone thrown into a pond. The splash where it lands is the direct loss, the immediate physical hit. The rings spreading outward are the indirect losses, the lost income, extra expenses, and lost use that follow. Splash first, ripples after. That picture carries you through any question here. If some of these concepts feel challenging right now, please do not worry. That is completely normal, and it is exactly why I created that practice question bank. Working through those problems will steadily build real confidence. So what feels tricky today becomes second nature well before your exam day arrives. Now, the numbers section that scares some students, the financial ratios, but I will keep it simple. First, 2 premium terms. Earned premium is the portion the insurer has actually earned by providing coverage for time already passed. Written premium is the total premium booked for all policies in a period, including both earned and unearned portions. 2 more terms complete the foundation. Incurred losses are the total cost of claims for a period, including amounts already paid plus amounts set aside in reserves for open claims not yet settled. Underwriting expenses are the costs of acquiring and servicing policies, such as agent commissions, advertising, salaries, and administration. With these 4 terms clear, the ratios become easy. The loss ratio measures the share of earned premium eaten up by incurred losses. In words, you divide incurred losses by earned premium. Imagine an insurer that paid $7 million in claims and earned $10 million in premium. That gives a loss ratio of 70%, so 70 cents of every earned dollar went to claims. What does a 70% loss ratio tell management? It means the company kept 30 cents of each earned dollar for expenses and profit. A lower loss ratio is generally better, and companies track it year over year and against industry benchmarks. Remember clearly, the loss ratio always uses earned premium as its base, never written premium. The expense ratio measures the share of written premium consumed by underwriting expenses. In words, you divide underwriting expenses by written premium. Suppose a company has expenses of about $2.5 million against written premium near $10.5 million. That works out to roughly 24 cents to write each premium dollar. The combined ratio is the single most watched measure of underwriting profitability, and it could not be simpler. You just add the loss ratio and the expense ratio together. The magic number is 100%. Below 100 means an underwriting profit, exactly 100 means break even, and above 100 means an underwriting loss. Let us see it in action. Add our 70% loss ratio to a 24% expense ratio. That reaches about 94% below 100 in underwriting profit. Now imagine an 82% loss ratio plus a 24% expense ratio totaling 106% a loss. Here is your exam tip and memory aid together. Memorize which premium each ratio uses, because that is the favorite trap. Loss ratio uses earned premium, expense ratio uses written premium, and combined ratio adds the two. Try the phrase, losses are earned, expenses are written, combined is the sum. Say it, and these become easy points. Remember that mastering these concepts takes practice and repetition. The free practice questions are designed to help you turn what you're learning here into exam-ready skill. There is a real difference between recognizing a formula on screen and confidently applying it under pressure, and steady practice is what closes that gap. Now let us calculate premiums and cancellations, an area full of easy points once it clicks. Start with earned and unearned premium. When an insured pays a full year upfront, the insurer has not earned it all yet. Earned premium covers time already passed, while unearned premium covers the remaining period and must be returned if cancelled. Let me walk through a clean example. Picture a 1-year homeowner's policy with an annual premium of $1,200 or $100 per month of coverage. After 4 months pass, the insurer has earned $400 and the remaining $800 is unearned. Earned plus unearned always adds back to the full premium. When a policy ends early, the refund depends on who cancels. Pro rata cancellation applies when the insurer cancels. The insured gets back the full unearned premium with no penalty in exact proportion to the unused days. On our $1,200 policy cancelled by the insurer after 90 days, the insured receives roughly $900 back. Short rate cancellation applies when the insured cancels before the expiration date. Now the insurer returns less than the full unearned premium, keeping a small penalty on top of what it earned. This covers fixed costs like commissions and setup that the company cannot recover on a short policy. Remember simply, short rate always returns less than pro rata. Flat cancellation is the easiest of the three. It happens when a policy is cancelled on its very effective date, so it is treated as if it never went into force. Because no coverage was ever provided, no premium is earned, and the entire premium is returned in full. Effective date cancellation means a complete refund every time. Now, separate three terms. Students constantly confuse. Cancellation ends a policy before its scheduled expiration date, and either party may do it. Non-renewal is the insurer's decision not to continue coverage when the term naturally expires. A lapse happens when the policy ends at expiration because the insured failed to pay the renewal premium. Same ending, different causes. Here is the exam tip that prevents the classic mistake. If a policy ends before its scheduled date, that is cancellation. If it ends right at the scheduled expiration, the answer is non-renewal or lapse, never cancellation. Non-renewal is the insurer choosing to stop, while a lapse is the insured letting it die by not paying. A quick memory aid ties it together. For refunds, the insurer is generous and the insured pays a price. Insurer cancels, pro rata, full refund. Insured cancels, short rate, a penalty applies. For endings, picture a calendar. Before the date is cancellation. On the date is non-renewal or lapse. That timeline keeps these terms straight. Do not forget to grab those free practice questions from the link in the description. With the knowledge you're gaining today, plus focused practice on calculation problems like these, you will walk into your California exam genuinely prepared. They are completely free and built to mirror the style and difficulty of real exam questions. Our final topic is rating methods, the three ways underwriters set a premium. The first is judgment rating. Here the underwriter sets the premium using personal knowledge and experience with no rate tables or manuals. It is most useful for unusual one-of-a-kind risks, like a rare work of art where class data is scarce. The second method is manual rating, also called class rating, and it is by far the most common. The underwriter sorts the risk into a class from a published manual, then multiplies the rate per unit by the number of units. For example, 60 units at $2 each produces a premium of $120. The third method is merit rating, with experience rating as its most common form. Merit rating adjusts the manual class rate up or down based on the insured's own actual loss history. A modification factor above 1 increases the premium, while a factor below 1 lowers it. So two businesses in one class can pay different premiums. There are two more merit variations to recognize. Retrospective rating sets the final premium from the insured's actual losses during the current policy period within agreed minimum and maximum limits. Schedule rating applies specific credits and debits to the manual rate based on physical or operational features, like the condition of equipment or quality of management. Here is your exam tip for rating methods. Keep the three straight by their data source. Judgment rating uses pure underwriter expertise with no tables. Manual rating uses published tables and classes and is the most common method. Merit or experience rating modifies those manual rates using the insured's own loss history, usually over about 3 years. A clean memory hook seals it. Think judgment is the gut, manual is the book, and merit is the mirror. The gut relies on the underwriter's instinct, the book relies on standard rate tables, and the mirror reflects the customer's own loss record back into the price. Gut, book, mirror. Repeat that trio and never mix them up. Let us bring everything together as we close. You now understand the organizations that shape the industry: ISO with its last cost data, ACORD with its forms, the WCIRB rating, California Workers' Compensation, and NCCI nationally. You know the 4 independent rating agencies that judge financial strength and the risk management methods professionals blend to identify loss exposures. You can also separate direct losses from the indirect ripple losses that follow, calculate the loss, expense, and combined ratios, and handle earned and unearned premium with pro rata, short rate, and flat cancellation. You can tell cancellation from non-renewal and lapse, and you can name the judgment, manual, and merit rating methods. That is comprehensive command. You have done real work today, and you should feel proud and prepared. Notice how these pieces connect. Organizations feed data into rates, ratios measure results, and rating methods turn it into a final premium. Now grab those free practice questions in the description, apply what you learned, and go past that California